Good morning and welcome to this Monday, January 30th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, this is going to be a very interesting week, in my opinion. A lot going on. The market's going to have a lot to trade off of. First of all, we're wrapping up the month of January. End of January is tomorrow. For those of you who maybe aren't aware, I do a lot of historical research, and I've studied the January barometer or January effect in the market. And I believe in the signals that it provides. It's not 100% accurate. I don't know anything that is 100% accurate, but there is definitely a strong positive correlation between how we perform in January versus how we perform during the balance of the year. The odds are much, much, much greater that we're going to have a good year if we have a good January. And right now, the S&P 500's more than 6% gain ranks in the top quadrant of all Januaries since 1950. So in the top quartile, top 25%. And that's where you want to be historically. You want to finish in that top 25%. And I believe the number for the month needs to be over about 4.15%. So again, we were over 6%. I think it was 6.02%. And so unless we drop a couple of percent here over the next 2 days, the S&P 500 month of January, at least this January 2023, will be placed amongst the top 25%. So we'll see what happens there. So that's just number one. Number two, we've got the Fed meeting. That starts tomorrow. It'll end on Wednesday with a policy decision. Also on Wednesday, we have the ADP employment report. Thursday, just in case we needed something else to throw into the mix, how about Apple, Amazon, and Google earnings coming up on Thursday after the close? We're going to see a lot of increase in earnings reports out this week. But those are three biggies coming out on Thursday. Friday, need one more thing. How about the non-farm payrolls? So it is going to be a very, very interesting week indeed. We are in a bullish time of the year historically. January 26th to February 3rd is a bullish period where the S&P 500 historically gains about 4 times what it normally does throughout the entire year. So the annualized return, January 26th to February 3rd, is about 35% on the S&P 500. Throughout the balance or the total of all years, the annual return for the year since 1950 is 9%. So this is clearly a more bullish period than usual. We're getting into the end of the month. A lot of money managers will buy stocks, put it in their portfolios ahead of the rush of money that's coming in, the new money from pension funds, 401ks, and so forth, beginning of the month. So lots going on. The other thing to always keep in mind, too, is the first half of a calendar quarter performs much better than the second half historically. And I think a lot of that has to do with shares being bid up heading into earnings. Then you get a little bit more movement with earnings to the upside. And then once earnings end, which is roughly about the second week of the second month of a quarter, I think the market tends to go through a profit-taking period. So January 1st to February 15th, much, much stronger historically than February 16th to March 31st. Again, that doesn't mean that the market every year goes up for a month and a half and then goes down for a month and a half. Don't take it quite so literally. But the tendency is for the market to do much better in the first 45 days of the quarter versus the second 45. So all of that keep in mind, but it is an interesting time for the market. And this week, I think in particular, because the S&P is right up against, I think we kind of went through, no matter how you draw your trend line, it looks like last week we broke the downtrend line from 2022, connecting all the highs through that period of lower highs and lower lows. I think we've broken that. And from there, the question is, can we get through some key price resistance levels. And I'm looking on the S&P 500 around 4,100. We'll talk about that in just a bit. Anyway, let's go ahead and go over to earningsbeats.com. It is going to be a very interesting week. If you scroll down over at our website, you will find an area to sign up for our free Earnings Beats Digest newsletter 3 times a week. Try to make it educational, just something to give back to the community, on all those who have supported us over the years, either through my blogs or through my shows or our service at Earnings Beats. I want to thank everybody for that. But check it out. Usually it's just a paragraph or 2 paragraphs in a chart, and normally talking about things that like relative strength and earnings and candlesticks and, short squeeze. We got a short squeeze stock that we put in there this morning, that we'll see what happens this week. I just think it's really educational. You got an opportunity to join us for any of our free webinars. We always reach out to anybody who's subscribed to our EB Digest. So anyway, number of reasons to sign up there. So as we move into this week, let's first start looking at what happened at the end of last week. I'll tell you one thing I really like. Look at these AD lines. I mean, there's your Dow, there's the S&P. Look at the NASDAQ just soaring in this last month. Mid caps, small caps. I mean, almost everything. Look at the sectors coming across. Discretionary, real estate, communication services, industrials, energy. Now, granted, these are all secondary indicators. I don't look at this and say, oh, the stock market's going up because the AD lines are going up. That is not the way I use these. But I do use them as confirmation for what I'm seeing on the chart. And what I'm seeing on the chart, first of all, the NASDAQ broke out to about a 4-month high, maybe a little over a 4-month high. That's pretty important. The S&P 500, this is the level I'm talking about. Both of these tops were right around 4,100. This top over here, which is a little covered up by the numbers, was 4,110. A close over 4,110 would be very, very bullish. Now, with futures down this morning, probably, and I don't think I mentioned the futures, but I'll talk about those in just a second. But with futures down, we've got some work to do here early in the week to try to make this breakout. But let's see, the futures, Dow futures right now down 150. S&P 500 futures down 31, NASDAQ futures down 131. So the NASDAQ about 1%, S&P about 0.75%. So you take off, 30, 35 points off of here. Maybe we open around 40, 40, 40, 35. Still well above the moving averages. To the downside, that's what I want to watch. Listen, if this is a trend, if we're now starting an uptrend, and I know there are plenty out there disagree with that, and I don't even necessarily agree with it yet. I mean, it's acting like it's an uptrend. We're bouncing off of key moving averages, going back up, but we got to get these breakouts. Like I said, NASDAQ, we got one. The S&P, no. The Dow, no. Mid caps got the breakout. Small caps looks like we're sitting right on it. So it's a mixed picture. It looks good. It's much better than the alternative or where we were 3 months ago. But is this just another false move to the upside and back down? We're going to find out. I'm seeing signals that suggest could be other than that. I think it could be the real deal. But we need price confirmation. We still need to get through these levels. So on the Dow, I'd be watching up, maybe around the 34,800 level, something like that. S&P 500, for me, clearly 4,110, 4,100, 4,110. A lot of overhead resistance there. I think we got up to, close to 4,090 on Friday. NASDAQ, we've already taken out the high. I mean, technically, this could run for another 1,000 points or more. We could head back for that August high. Not a whole lot of resistance, maybe a little bit of a reaction high in September to watch out for. But otherwise, if we could break out and we confirm this uptrend, I think we're going back to the August high. And I think that will be the next big test. Mid caps, small caps, you can see them, breaking out, looking pretty good on the AD line. Small caps maybe need just a little bit of a push through resistance. Discretionary. So looking at the sectors, remember how bad discretionary was 1 month ago? Well, went from a 52-week high, or excuse me, a 52-week low to about a 4-month high in 4 weeks. So completely changed, and you can see a lot of money coming in. supporting this move to the upside with the AD line. Real estate breaking out above that 40 level, which I think is pretty important as well. Communication services, after a very, very weak 2022, probably the worst sector of the year. I think this one's getting off to a good start, and we could see higher prices down the road on XLC. This is a group I expect to be a leader. If the market does continue moving higher, this is a group that I would look for further strength out of. Industrials consolidating, nothing, we're not making the breakout here, but in a nice bullish pattern. There's a flagpole, and this looks like a flag to me. Sideways consolidation. Get that breakout above about 103, 104. I think that would get this group going again. And then there's energy, which pulled back 2% on Friday, but remains above its 20-day moving average. And off of this move to the upside, looks to me like a little bit of a cup. So I think we have an uptrend, a cup. Maybe we get a pullback to that 20-day moving average, maybe even slightly below, but I think that handle would be viable. I would expect energy to go higher as well. 10-year Treasury yield. So as far as economic reports, nothing this morning. I mean, I don't think there was anything due out today. So the market will kind of just trade off of a few earnings reports, not really much in the way of earnings reports today. I think that'll pick up as we move throughout the week. So market just looking at technicals, maybe a little overbought in the near term. We've had a pretty big run. Didn't finish quite so good on Friday. So maybe that'll carry over here, at least in the morning. Just remember, and I've talked about this for many months now, I don't even blink anymore when I wake up and see red futures. I mean, how many times have we had gap downs? And then by the end of the day, we're either green or we've made up a lot of that ground. That's been really the theme since probably May of last year. It's been crazy in terms of gap downs and morning weakness, followed by buying the rest of the day. We'll see if today's any different. Mondays do tend to be weaker, although not so much when you're at the end of the month, beginning of the month. I think the new money coming in tends to drive the market a little bit more than maybe the psychological Monday effect. 10-year Treasury yield here. Okay, so we've got, let me just pull this up, make sure we got the latest here, 3.55%. So we've been trending up a little bit. We all know the basics of this move to the upside. So let's shorten this a little bit. Just going to look at the last 3 months. So here you can see this 10-year Treasury yield coming down. We were at 4.20 2 months ago, 2.5 months ago, 4.20. Went all the way back down to 3.40. This is a high that I think bears watching in the future if we do keep going higher, 3.90, because on the way back down here, clearly we have another, slightly lower low, but I'm calling it a double bottom. And then that means the high in between, which was back in December. That's the one that, in my opinion, if you are bearish, the 10-year Treasury, you really want to see the yield move back up through that 3.90 level. Because when yields go up, remember, when yields go up, prices go down. Treasury prices go down, yields go up. Always that 100% inverse relationship. It's just the math, the way it works. So as prices go down on the Treasury, yields go up, and the opposite as well. So that's why when you see the yield going up, that means people are bailing on Treasuries. When the yield's coming down, means folks are buying. And one argument I've had here in 2023, and maybe even since November, is who in their right mind would buy 10-year Treasury yields yielding as low as 3.37% recently if you were worried about inflation. Anybody buying Treasuries is going to demand a higher return. I'm telling you, the bond market is done with inflation. D-O-N-E, done. It's going to be really interesting to see what the Fed has to say here over the next couple of days. The Fed, they're going to have to kind of lay out what they're seeing down the road. And I think that's what the market's really anticipating. They've gotten a little bit more hawkish, I would say, over the past few months in terms of raising what they think is the short term, where we're going. And the stock market and the bond market, I'm telling you, don't care about. I mean, I guess if Fed Chief Powell comes out and says something like, we're seeing undertones of building inflation, and we might see the need to even raise rates faster going forward. I mean, if he just off, and it could happen. I mean, I saw August Jackson Hole. I'm not going to get back into that today, but I think anything goes with this Fed, which is not a good thing when you're talking about the Fed. You want to kind of have an idea that transparency is important. That's kind of what Bernanke did years and years ago. Tried to instill a sense of transparency into the Fed and what they're thinking, what they're doing, so it doesn't come as a shock to the bond and stock markets. I don't think Jay Powell's doing a great job of that, to be quite honest. I mean, first of all, from the very beginning, remember, and hey, I'm not necessarily criticizing him. It was a very difficult period going through the pandemic and knowing what exactly you should do. I said from the very beginning that inflation was, transitory as well. I thought it would be a few months and boom, it's out of the way. I was completely wrong. I mean, it's lasted much longer. But I do think in the long-term scheme of things, that's what it's going to turn out to be. It's going to turn out to be a blip up to 6% and then back down to 2%. That's what I think is going to happen. Anyway, the Fed throughout the last couple of years has been all over the place. And again, part of it, I wouldn't want to be in their shoes. The last 2 years, it's been a very difficult period for a lot of folks in a lot of different areas, not just financial, but obviously healthcare and so forth. But I think it's getting a little bit clearer now. And I know sometimes the Fed likes to talk tough so that it lets the market do its thing, kind of helps the Fed. So we'll see if it's just tough talk or if this is something that they really think they need to keep raising rates. Hey, if inflation's a problem, I agree with them. You got to knock it out. But the bond market's saying it's not a problem. And so that's where the disconnect's coming in. Anyway, when the Fed reports on Wednesday, I think that's going to be a really interesting time. We could see, I mean, the volatility could be extreme once again. And, if he drops another bomb, we could see another, quick move lower. Again, I'm going to go over sentiment here in a couple minutes. I'm seeing changes in sentiment that if we do have a quick drop, I think that's all it's going to be. I really don't think we're going back down. Could I be wrong? Of course. Nobody knows. I have no crystal ball. I just try to use everything that I have, all my resources, to give me the best idea. It's all about risk management. And the signs I'm seeing tell me we're going higher on the S&P 500 and that we're going lower on the 10-year Treasury yield. And I think we could have a pretty good rally in 2023. I really believe that. I do not rule out the possibility that we will be at an all-time high later this year. I think probably it's more likely that it'll be in 2024. But if the Fed, if inflation does start to go away quicker and the Fed then has the ability to act a little faster on a possible recession and can begin cutting rates sooner later this year, I think that could spur the market big time. But I'm getting way ahead of myself. We got a lot of work to do. And so let's move on here. Let's look at the S&P 500. So first things first, price resistance. I believe the downtrend has ended. I think it's over. That's just my call. I don't care how I draw this line on the S&P 500 chart. That's drawing the line to connect intraday highs. And we've got two closes above it now. If I look at candle bodies, which is opens and closes on these candlesticks right about there, I mean, that's connecting this candle body right about that one, this one, and then the breakout there. You can draw your lines however you want. It's really hard to make this line. I don't know what you're connecting here. I mean, unless you just want to keep connecting 2 points, because that's all it's doing. I mean, a trend line, honestly, people misuse trend lines. Here's a trend line, and then this one, okay, it gets a little bit better. The problem is that slope is going down so fast, you're eventually going to break that, right? So then you got this one. Or maybe even you got this one because it starts to roll over. So let's draw the line there. Oh, wait, we break out again. How about this one? Well, this one turned out to be a pretty significant one because this is the one we've been riding for the last year, maybe 13 months. And looks to me like it's broken. We got the golden cross, 20 coming back up above the 50. All these prior times that we've seen this, where we get the golden cross, we've not broken the downtrend line. This time, we've broken it. Now, does that in itself mean that market can't go lower? No. It's just one more clue. It's just one more technical obstacle that we got through. What I normally like to do is when I see trend lines and I see breaks, is I like to get confirmation above the prior price highs. So that's going to be there with this double top. It's going to be here, 41.10. That's that close in September. And then honestly, the biggest one from a price perspective, forget about the trend line, price perspective is the one in August because we have a lower low, lower high, lower low, lower high, lower low, lower high. And so right now we're either waiting for this next lower low or to break above this high, because until we break above this high, we still have that pattern in play. So there's the bearish argument and it's still there. I mean, if you get through 4,300, I'm not sure that there's really a whole lot left on the bearish side. But hey, I'm just trying to give both sides. I'm seeing signals that we're going higher. And I'll go over a couple of sentiment signals in just a minute. NASDAQ. So NASDAQ here, you can see we actually did make a breakout. It was very slight because we gave up some gains late in the day on Friday. But here was the open, 12,141. And here's the close, 12,166. We closed above it. The intraday was, oh no, excuse me, the intraday was 12, or the close was 12,141. Or okay, let me start all over again. I'm confusing myself. The open, so the high candle body, the open was 12,141. Intraday, 12,166. We closed at 12,166. So if you're looking at the intraday as the key resistance level, which I think that's kind of comparing apples and oranges. If you're going to take an intraday here, you probably ought to take an intraday here. But it looks to me like we got that breakout. I mean, I don't know if you noticed the volume, big time volume surge on the NASDAQ to accompany that breakout. So all of this, in my opinion, looks really good. Now, we could have a false breakout here. I mean, I've seen it plenty of times before. I do like the fact that we're getting all of these hollow candles. And if you want to know why the AD line's going up like this, it's because of all of these hollow candles. The AD line is calculated based on where you close relative to your trading range for that day. So you can have gap downs. You can have days like this when you're down, like this day right here. The OBV would have gone straight down on balance volume because you closed lower. That's the only thing it looks at. You closed lower. The AD line, on the other hand, though, says, well, yeah, but you gapped down and then there was buying all day long. We closed near the high of the day. So you're telling me that that candle right there is the same as this candle right here, this big red one? Because on the OBV, they're treated the same. You finished lower, you subtract all the volume, all of it. I mean, it makes no sense to me. That's why I don't follow the OBV. And if you want to see what it looks like versus the AD line, I mean, here's the AD line breaking out to new highs. Here's the OBV, hasn't even gotten above the December high. Still, it's been going down since August. I mean, it basically does whatever the market does for the most part. It'll give a subtle divergence once in a while. But basically, if the market's going down, OBV goes down. If the market goes up, OBV goes up. I mean, I find no use in it personally. To me, this is a much more important signal. getting that breakout on the AD line after just a little bit of strength. I mean, we're higher now on the AD than we were in August. It's because of all the gap downs and recoveries, intraday movement, finishing with tails. Any day, even if it's red like this, if it has a tail and it comes back up and it closes in the middle, there's no change in AD. And if it was down like this day, 3 days ago, this has been last Wednesday, where it's down pretty significant intraday. I think that was the day after Microsoft reported. And then we came roaring back. That we saw a big move up in the AD line. You can see the OBV goes down. So looking at the two, I just feel like the AD line gives us a much better signal, but everybody has their own way of looking at the market. And I'm not saying one is wrong, one is right. I'm just saying one is better for me. All right, let's talk a little bit about the equity only put call ratio. I want to talk sentiment for the next 5 minutes before we wrap up. So here, I mean, this has been a really important signal over the years. This is a 253-day moving average of the equity only put call ratio. It is the freight liner of sentiment. Sometimes I watch the 5-day moving average. That's the speedboat. That tells you the short-term tops and bottoms, especially bottoms, when that 5-day moving average goes up. The 253-day moving average is much important, much more important from a long-term perspective. So here, when you see the 253-day moving average start to go down and stays in this downtrend for a while, the market, this is the S&P down here, tends to go up. When we turn higher and we go through a period of rising equity only put call ratios, the market tends to be very weak from peak to peak. That's what I'm connecting down here. Now, while it was rising here for a little while, we kept going up. So again, it's not a perfect signal, but from here, when it started to take off, I mean, that was the start of a pretty significant bear market. And then we rolled over. And when we rolled over, it was, you wanted to be long the market. The next 2 years, we went up 101%, while the equity only put call ratio, this 1 year ratio, was coming down. But when it turned and started moving back up, market did nothing. Here we were down 4% for over a year. Then we roll over and we start to move lower. What happens? Well, go up 56% over the next 2 years. And we turn up, nothing. We turn down, big rally. We right in here, I mean, you can kind of follow a little bit with each one of these moves, but this was a lot of whipsaw. This would have given you a lot of bad signals, in my opinion, because here, as it turns up, you're thinking you're going to fall apart. And you did briefly, and then you start rising again. And then here you're rolling over. I guess you did rise a little bit during that. But anyway, there's a lot of chop. But here, look at this. When we were going straight down, look what the market did. That was the biggest 22-month advance since back in the 1930s. Almost 100 years since we've seen that kind of an advance. And that was the equity only put call ratio getting so incredibly bullish that the market had nowhere to go. And when this turned over, and this was a year ago at Market Vision, I said at Market Vision 2022, this was the biggest problem market faced. Sentiment. We needed to reset sentiment, and it was going to be painful while this line went up. And there it is. But look where we are now. And what I'm seeing here is a hook. Now, and this is important because on this particular chart, remember, I think there are some bad readings on the CPC. I'm going to pull up the daily. So look at all these crazy high readings in November and December. I don't want to take a whole lot of time because I want to keep talking about these other issues, but I went in and I've done a user defined index, and a lot of these days were middle of the week. A lot of these days were Wednesdays when something was going on with market makers, and they were taking this, they were taking some kind of positions with equity puts, I think on some of the larger NASDAQ names. And honestly, what we're trying to do is we're trying to understand the psyche of the retail trader. And so it's distorting everything. I don't care what the big money's doing with equity put up. I want to know what the individuals are doing. because they take things to extreme. And when they hit extremes, that's when markets reverse. And on the 253 day, when it starts to roll over, it's really important. So let's go back now. Look at that rolling over right here. It looks like it may be starting to peak, but let me show you when I use my user-defined index, this is what it's looking like right now. And it is starting to roll over. Now, what that means is that folks are not quite as pessimistic. It's been coming down. And when you start running out of fear, you start running out of sellers. This is sentiment point number one. Here's sentiment point number two, the VIX. Look at every move down in the S&P. Boom, up into the mid to upper 30s. Right there, right on the pullback on the selling. This low, mid to upper 30s. This low, mid 30s. This low, mid 30s. This low, wait a minute. This low wasn't even going up. And we talked about it back at the beginning of the year. I've been telling members, I've been talking about it on the shows. I wrote an article at Stock Charts. When the VIX is coming down with the S&P 500, market makers are no longer pricing options as high as they were. In other words, they're not expecting a lot of volatility. And volatility is associated with selling. Volatility spikes when you sell. And the market makers are telling us, yeah, we don't see it. We just don't see all the selling. We think we're done. And look at what's happening here. In previous moves down the VIX, we did go down 18 to 20 area. I mean, to be honest, we're down about where we were before. But we went down and boom. We went down, boom, down, started to make the move up. This time we're down and we're just meandering down here like we want to break down. I'm telling you, between the equity only put call ratio and the VIX, I think the market is telling me that sentiment, which we needed to reset a year ago, has reset. And the bears no longer have this in their camp. So while the media is still trying to scare everybody, the equity only put call ratio is basically saying, hey, it's over. The VIX is saying, hey, it's over. So these are beneath the, I mean, these aren't necessarily what I use to confirm that a new bull market advance has begun. What I use to confirm is the price action. These are the signals telling me to get the heck off of the short bandwagon. I mean, these were a couple of things that told me, a few months ago, but we've had rotation and manipulation since back in May of last year. And to all the, I'm going to finish with this. To all the bears who said the market can't go higher when the Fed is hawkish and raising rates, I want you to know that if we go back and look at the S&P 500, at the end of May, right here at this low, the Fed funds rate was at 1. We're now at 4.5. And look at where we are. The media might be telling you that we keep going lower and that everything's horrible. But since we started those 75 basis point hikes, the stock market's higher now than it was then. So everyone who said market can't go higher with rates going higher, never happened before in history, can't happen. Well, it just happened. It also happened in 2004, by the way, because whoever says it's never happened doesn't check their history very well. 2004, the market went up over 2 years, 10% from 2004 to 2006 with 17 consecutive rate hikes. It's not all about rate hikes. Anyway, I'm going to leave everybody with that. Let's see what the market's doing. Open up. NASDAQ down 115, S&P 23, Dow 57. We've had a big move up. You're not going to go up every day. We're near key resistance. A pullback is very possible. Watch those moving averages, short-term moving averages like the 20-day to the downside. I think as long as we stay up above that, I think the market continues to look pretty good here. Everybody have a great day. I'll be back tomorrow over at Stock Charts TV right there. 9 o'clock tomorrow. Just click on that. You can come right into my show. And I'll be back here at Earnings Beats on Wednesday for your next Trading Places Live here. Have a great day, everybody. Happy trading.